Britain has passed an emergency law giving the government control of a steel plant in Lincolnshire to avert closure. The plant's Chinese owners Jingye Group said its blast furnaces were financially unsustainable after rejecting a £500 million, that's $650 million rescue in March. British officials said that nationalizing the plant was a probable next step. And Fitch has upgraded Nigeria's risk ratings and endorsement of ongoing reforms in the country. We are at a time when forecasting is getting even more difficult, particularly with unpredictable geopolitics, where rules are poorly understood and information incomplete. Being able to get your scenarios right could imply a huge upside. Getting it wrong can be disastrous. Hello and welcome to Global Business Insights, where we bring you more depth on the latest business headlines. And thank you for your time. America continued to walk back some tariffs by exempting electronic parts and devices, including phones and computers, from its new levies on Chinese goods. It was later clarified that these are still subject to existing tariffs of 20% but exempted from higher reciprocal tariffs. Apple and other impacted players had been arguing that the reshoring of production back to the US is not a matter of weeks, inevitably resulting in higher prices for American consumers. The reversals also help Tesla, whose electric vehicles all have flat touchscreen displays and come with advanced onboard computers. Markets will read this move as a sign of flexibility, as Trump roiled markets for days and worried America's tech giants who make many of their products in China. U.S. Commerce Secretary Howard Lutnick also said the reciprocal tariff exemptions for some electronics may be short-lived and that separate tariffs for these products are coming soon. Like I said, the exemption allows more time for these companies impacted to make needed reshoring adjustments. China is moving more towards ASEAN countries and Europe and will need to perhaps redirect a huge amount of idle capacity towards possibly Africa and emerging economies. Watch out for dumping in less alert regulatory environments in, say, Africa and even possibly in Europe. On Friday, we saw the first of the major banks, JP Morgan, Wells Fargo, BNY, and Morgan Stanley, present their earnings, all topping analysts' expectations for the quarter. The main takeaway was that bank executives are in a fog on the US economy and prepared for all scenarios, including bracing for a slowdown. Bank stocks were initially lower after the announcement, but they staged a modest rally, tracking the broader markets later in the day. The KBW Nasdaq Bank Index closed 0.6% higher. That was on Friday. The three main Wall Street indexes also all snapped two-week losing streaks, finishing in positive territory. In what looked like a rush for cash, US bond yields surged on Friday as investors dumped bonds in response to renewed fears of an economic slowdown. Bond yields and prices move inversely. The 30-year yield also rose to 4.873%. That was last week, the largest one-week yield gain since April 1987. The hope of the US administration will be that the narrative shifts towards some wins in the trade talks, perhaps with Japan or less likely Europe, and then more traction on market-friendly regulation and tax cuts legislation. But of course, we know that the regulation can also mean new shocks ahead. Markets are not likely to give the US administration the benefit of the doubt, though there are irresistible dips to buy. One should still expect a lot of volatility in the next likely to be extended 90-day pause window. We get more quarterly financial reports this week. Goldman Sachs, Bank of America, Citi, Johnson & Johnson, Taiwan Semiconductor, and Netflix are expected to provide updates, among others. Consumer confidence in the United States continued to deteriorate in April, with the University of Michigan's Consumer Sentiment Index down to 50.8 in the flash estimate from 57 in March. This was worse than market expectation of 54.5. Still on data, indeed, another better than expected report on US inflation also did little to help the mood. It could, however, give the Federal Reserve more leeway to cut interest rates if it feels the need to support the economy. Lower rates would mean cheaper mortgages and other loans. On Friday in the US, the headline Producer Price Index, that's PPI, or Factory Gate inflation, also called wholesale inflation, in March swung to a negative 0.4% from plus 0.2% expected, also the lowest level since October 2023. Year over year, PPI also came in lower than expected at 2.7%, much lower than the 3.3% that analysts thought they would get. But Friday's March report on inflation at the wholesale level was, as we know, a backward-looking indicator. The concern is that inflation will feel more upward pressure in coming months as Trump's tariffs are felt through the economy. And we could get the first reactions from major central banks on recent tariff actions. This week, on Wednesday, Bank of Canada officials could keep borrowing costs on hold as it watches the potential inflationary impact of an ongoing tariff battle with the US, while the European Central Bank on Thursday is widely anticipated to reduce interest rates. The next US Federal Reserve decision isn't until May 7. Fitch Ratings in London on Friday upgraded Nigeria's long-term foreign currency issuer default rating to B from B-, still in the highly speculative category of risk, but the outlook is stable. The upgrade reflects increased confidence in the government's broad commitment to policy reforms implemented since its move to orthodox economic policies in June 2023, including exchange rate liberalization, monetary policy tightening, and steps to end deficit monetization and remove fuel subsidies. These, Fitch said, have improved policy coherence and credibility and reduced economic distortions and near-term risks to macroeconomic stability, also enhancing resilience in the context of persistent domestic challenges and heightened external risks. Fitch for Nigeria projects inflation, which reached 23.2% year-on-year in February 2025 under the recently rebased CPI, to average 22% in 2025. And the government, as you know, had anticipated inflation at 15% in 2025. Fitch also does not anticipate a premature easing of monetary policy given the higher inflation readings. Nigerian economy continues to show resilience despite headwinds as the Purchasing Managers Index moves up in expansion territory. The Central Bank of Nigeria Composite PMI for March 2025 came in at 52.3 index points, showing expansion in economic activities for the third consecutive month. The government is consolidating on improvements to achieve an economic recovery, which still needs to address major growth headwinds like high inflation, weak infrastructure, unsteady and inadequate electricity, as well as gaps in many social and welfare dimensions. There's also need to do more to enhance market competitiveness and build skills, revamping education, especially for a growing young population where there are all kinds of opportunities to get them equipped with skills for the new digital age. A lot to be done to get ratings upgraded towards investment grade. The Parliament in Britain had an emergency debate on Saturday to prevent closure of a steel plant in Lincolnshire, which employs 3,500 people at its Scunthorpe plant. The plant is now said to be operating at a loss of £700,000. That's about $915,600 a day. Loss of competitiveness leading to a deindustrialization of the West is becoming more of a concern as the UK is looking at nationalization to save jobs. The closure of the steel plant means Britain will be the only G7 country unable to produce so-called virgin steel from iron ore, coke, and other inputs. Even before energy costs shot up in recent years, an oversupplied global market, thanks to China, weighed on ability to recover costs. The US tariffs of 25% on steel imports was another blow, as the US receives about 5% of British steel exports worth £400 million a year. While negotiations are ongoing to remove the tariffs, the UK government has already allocated £2.5 billion to support the industry, with a strategy for the sector to be released later in the year. If British Steel were nationalized, it would be the biggest state rescue since a number of banks were taken into government hands in 2008. Just hours before the debate began, British steel workers prevented Chinese executives from entering the Scunthorpe steelworks in a dramatic standoff. This was before a rebuke in the Commons as Business Secretary Mr. Reynolds accused Jingye, the Chinese steelmaking owner of British Steel, of planning to irrevocably and unilaterally close down primary steelmaking in the UK, waving the populist anti-China flag. This is another blow for globalization and fuels more suspicion of Chinese dumping and massive subsidies killing Western factories. US Steel is also in need of investments to upgrade its infrastructure as Nippon Steel is trying to take it over. There is still hope that private investment can be secured to save the UK steel plant, which would avoid the need for a complete state takeover. It remains unclear how long the government can hold on without an outright nationalization, and even that will not solve the competitiveness issues. Building modern and greener furnace replacement, for example, would cost an additional $6 billion, money the UK government may not have given the tight fiscal situation. As for China, its strategic competitive advantage in steel production has become formidable. Already well ahead of the United States in terms of manufacturing capacity, China also produces over half the global supply of steel, aluminium, and ships. UK Steel not likely to be the last victim of the spreading deindustrialization plague, as the rest of Europe also struggles to keep its factories afloat. Meanwhile, China's Commerce Minister Wang Wentao has told the Director General of the World Trade Organization, Dr. Ngozi Okonjo-Iweala, that the United States tariffs will inflict serious harm on the developing countries. This is just as Okonjo-Iweala has said she remains optimistic about opportunities in the current global trade crisis. China's March exports spiked up 12.4% last month in US dollar terms from a year earlier, and more than expected as businesses front-loaded outbound shipments to avoid prohibitive US tariffs. Imports fell 4.3%, extending declines as sluggish domestic demand persisted. Asia-Pacific markets climbed as the US administration paused tariffs on some consumer electronics, boosting risk sentiment. Singapore's central bank announced today that it had eased monetary policy for the second consecutive quarter in expectation of lower economic growth due to the global trade war. Oil prices mostly flat amid concerns the escalating trade war could hurt global economic growth and dent fuel demand. Brent crude futures under $65 a barrel in early morning trade. Well, that's all on Global Business Insights. Thanks for watching. Bye-bye.